Hi, I'm David Stein of Money for the Rest of Us, and in this video I answer the question, how does Robinhood and other brokerage firms make money if they don't charge any fees or commissions, or hardly any fees or commissions? And what happens if Robinhood or another broker goes bankrupt? Robinhood is an incredible app where you can purchase stocks and exchange traded funds and not pay any commission. Other brokerage firms such as Vanguard, TD Ameritrade, Fidelity, they offer commission-free trading. If they're not charging you any type of commissions or fee, how do they make money? Well, first, they hope that you will invest in some of their products or services where they actually charge a fee. Maybe you start out with the commission-free or the no-fee product, but hopefully you'll use them for something else. A second way that they make money is through some of their services, such as margin lending. As an investor, you can borrow money and then invest it. And to do that, you have to take out a loan, a margin loan. The brokerage firms will charge interest on that loan, and they can make money that way. A third thing they can do is securities lending. Some investors want to borrow shares and sell them short. So they borrow the stock, they sell it, hopefully the stock falls in price, they buy the stock back, and then they return the shares that they borrowed. Well, in order to do that, they have to pay a fee, and brokerage firms charges a small fee for securities lending. Another way brokerage firms make money is they might not pay you interest on your cash balances. Robinhood, that's what they do. If you have cash in your Robinhood account, they're not paying you any interest. They're investing that money and they're earning the interest, and that way they can make money without charging you any fees. A final way that brokerage firms make money without charging any type of fees to some of their clients is they'll direct trades to particular execution services that will trade those stocks. So if you place an order, Robinhood is taking that order, maybe they're combining it with other orders, and they're sending it out to an execution services. So they're directing the trade. These execution services, such as Citadel's execution services, they're huge and they're very, very efficient. They're willing to pay for that trading volume. Robinhood makes $270 for every $1 million of volume, of trading volume they send to a particular brokerage or execution services. Now you can Google SEC 606 report for Robinhood, for Vanguard, TD Ameritrade, and you can find out where they're directing their trades to. Sometimes they're getting paid for it, sometimes they're not. Vanguard doesn't get paid at all for directing trades. So that's how brokerage firms make money. They make money on margin loans, securities lending, directing trades. Sometimes they make money on uninvested cash, and hopefully they also make money if you subscribe to one of their services that they charge a fee for. Now, what happens if a brokerage firm goes bankrupt? Well, you're protected, and you're protected in a number of ways. One, there's a rule, it's SEC Rule 15C33, and that's the Customer Protection Rule. Brokerage firms are required to keep their customers' assets separate and segregated from the corporate assets that the brokerage firm has. So they can't be commingling the corporation's money, the brokerage firm's money, with clients' money. So there's that protection there. Another rule is SEC Rule 15C3-1. This is a net capital rule. Brokerage firms are required to keep a certain amount of money or capital to protect their clients in case they go bankrupt. So it has to be unencumbered, just cash that they keep aside. A third way you're protected in case a brokerage firm goes under is there's insurance. It's called the Securities Investor Protection Corporation, or SIPC. This will pay if your broker goes bankrupt, you'll get up to $250,000 in cash or $500,000 in cash and securities. So if you have $500,000 of securities and cash in your account, you'll get reimbursed for that. So there's that additional insurance protection. This is self-insurance, so the different brokerage firms have kind of come together and they have this protection, and the government is involved to make sure that everything is set up so that you're protected. Finally, if a brokerage firm would go bankrupt, usually what happens if it's close to it, they'll just sell the assets, and another more profitable brokerage firm just takes over those accounts. For example, E-Trade recently paid $170 per account from Capital One Investing. So they just sold the accounts and you woke up and you were an E-Trade customer. So that's also what happens. Finally, if you're concerned about your broker, you want to move those securities, but you don't want to sell them, you can transfer securities in kind. It costs about $75 to do so. You just call your broker and they'll move it over to your new brokerage account. You don't have to sell the securities and pay any type of capital gains if you're trying to avoid that. So that's how brokerage firms make money. That's how you protect in case they go bankrupt, and how you transfer your securities if you want from one brokerage firm to another. If you have any questions, go ahead and leave those in the comments. Thanks.